Welcome. In this video, I'm analyzing Mahindra Holidays and Resorts. We'll be looking at the profit and loss account analysis first. The data is from March 15 till March 19, as also we have the data for 12 trailing months or the recent 12 months. So we'll begin our analysis of the P&L account by looking at the sales or the revenue trend, and that should be increasing over the years, which we see in this chart. In 15, the company had generated a revenue of 812 crores, whereas in the recent 12 months, it is at 2,390 crores, the highest till date. It would be a red flag if the sales or the revenue is declining for multiple years. It would also be a red flag if the growth in sales or revenue is there, but cash is not being received or generated. That is, there is a mismatch with the cash flow statement, which we can observe when we analyze the cash flow statement. It would also be a red flag if the company is doing large amount of sales to related parties or subsidiaries. Again, that can be seen from the annual statement. Next, we'll look at the sales growth. The recent 3 years sales growth should be more than the last 5 years sales growth, which we don't see in this particular chart. From last 5 years onward, there was a growth of around 27%, but in the recent 3 years, the sales or revenue has dropped to 11%, or the growth is at 11.8%. And from 19 to the recent 12 months, or from 2018 to recent 12 months, the sales growth is just 6.7%. It would be a red flag if there is inconsistent growth or variation in the sales figure. Although this is still good because we want the sales growth to be above 10% at least. Next, we'll look at the sales to operating expenses. In this, if there is large variations in the expenses year on year, that would be a red flag. We don't see a variation as such, but we do see a trend increasing. It would also be a red flag if there is an increase in the purchase expenses or expenses, but cash is not being paid out. That is, there is a mismatch with the cash flow statement. Again, we can look at the cash flow statement in part 3 and understand whether the company's sales or profits that are being generated, are they matching up with the cash the company is showing in its cash flow statement or cash from operating activities. It would be a red flag if there are large purchases from related parties, as I mentioned again, or subsidiaries. This can be verified by looking at the annual statement. Somewhere in the annual statement, we'll find the related party transactions. What percentage of the sales is being done through related parties or purchases being done through related parties. So here we do see that sales and expenses both are increasing year on year. Let's look at the operating profit margin. This should be greater than 15% for most of the years. In March 17, it dropped below 15, and in March 19, it even fell below the 10%. That is the cutoff, at least for me. In the recent 12 months, it seems to have gone up back to 14.2%. If there are large variations in OPM year on year, that would be a red flag. Although we see a declining operating profit margin, and 19 was very bad as such, so we do see a declining trend. If there is a large variation in OPM year on year, that's a red flag, as I mentioned earlier. We can also look at the operating profit margin of the other peer group companies. In individual years, the OPM can vary, but if we look at the 5 years and 3 years average, if that is above 15%, then that's all right, because we are also looking at a long-term trend along with the near-term trend. So for both the 5 years on average as well as the last 3 years on average, the OPM has gone down below 15%. Now, why I am saying 15% is because from the after the company has shown the operating profit, there are further expenses which still needs to be deducted, like the interest cost, depreciation, tax, any exceptional items, or extraordinary gains or losses. that also needs to be deducted. So finally, the net profit should not fall below 10%. So if the OPM itself is not above 15, most likely the NPM will fall below 10%. Let's look at the other income percentage. Here we are trying to understand income which has come through other sources. It should not be more than 20% of the total sales or the revenue, because we don't want too much profit that is being shown to be coming from other income. We want the main business activity to contribute to the total net profit. Anything else coming from the other income is a welcome thing, but otherwise we don't want to see a very huge percentage in the net profit from the other income. So here we see that the net other income from 17 has been coming in, whereas till March 19 it had gone up to 2.53%. But in the first two, 15 and 16, in March 15 and March 16, we saw other expenses into the business, which has been no longer there from March 17 onwards. So that's a good sign. When we look at the sales to other income, we have to look for red flags, and if there are large variations in other income year on year, then that would be considered as a red flag. You can see a steady rise in the other income for the last at least 3 years and the recent 12 months. It would also be a red flag if the income from other sources forms a major portion of the net profit, which I already spoke about earlier. Let's look at the raw material cost percentage. This is one of the major costs for manufacturing industries, and any change or increase in raw material cost affects the net profit. Raw material cost should not be greater than 80% of the sales. Here in this case, this company being mostly service oriented, the raw material cost would be nominal or minimal. If there are large variations in expenses or raw material cost year on year, that would be a red flag. We don't see a major change in the raw material cost. Red flag if also there is a mismatch of raw material expenses from the industry standard. How much expenses is being incurred by the other companies, peer group companies, that needs to be checked. Employee cost percentage. Here we are trying to understand what is the employee cost as a percentage of total sales. This is one of the major costs for service industry, and here too any increase in employee cost would affect the net profit. Here we see a steady rise in employee cost from 20% to 25% in the last 5 years. This is a gradual rise, so it's okay. And it being service oriented, it would always have a high percentage of expenses in employee cost. Employee cost should not be greater than 50% of the sales for the service industry, which it is not. And if there are large variation in expenses on employee cost year on year, then that would be a red flag, which we don't see here. So in most of these ratios, we are trying to understand and analyze and look for red flags or potential problems that we can find out. And then if these problems are big enough or we cannot find the solution for these problems, then we should avoid going into these companies. Next, we'll look at the depreciation percentage. This is the percentage as of sales, and it measures the amount of depreciation a company is charging or reducing every year from its profit and loss account for the assets that it has purchased. And depreciation should not be greater than 20% of the total sales. Here we see that none of the years the depreciation has formed a huge portion of the total sales, and it has always been below 10%. So this is a good. It should be stable over the years. In fact, it has been reducing, which means the company's capital expenditure has been almost done, and that is why most of its depreciations has been deducted already from its gross block or total assets. It would be a red flag if there are large variations in the depreciation rate being charged to the P&L account year on year. We don't see that. In fact, we see a positive sign where the depreciation percentage is being reduced to now below 5%, and then that would give us a stable net profit figure going ahead. As I mentioned, the depreciation should not be greater than 20% of the sales. In this chart of the sales and depreciation values, we have to look for a value of depreciation which is stable over the years. We see from 66 to 209 crores in the recent 12 months of depreciation. So we see that the depreciation being charged to the P&L account has increased by almost double of what it was in March 19. So here we see that maybe the company has increased its assets, and therefore the depreciation being charged has also increased to 200 crores. If there are large variations in depreciation value year on year, then that would be considered a red flag. At least for the first 4 years from 16 to 19, it was quite stable, except for the recent 12 months where the depreciation has gone up to 209. When the depreciation increases, it means the company's assets have also increased. So that when we look at the balance sheet, we will understand. Next, we'll look at the interest as a percentage of total sales, and it measures the amount of interest the company has to pay from the revenue it has earned through sales and services on its borrowings that it has undertaken. Interest cost should not be greater than 20% of the sales. In none of the years the interest cost as a percentage of total sales has exceeded 20%. In fact, it has always been below 4%. So this shows that the company's debt is very low. That is why it has to pay very low amount of interest cost as well. So each ratio helps us understand what the counter entry in the other statements would look like. So this interest cost as a percentage of total sales is all okay. Individually, if we look, the interest expenses should be stable over the years, which we see here. It's quite stable. And if there are large variations in the finance cost, then that should be investigated, as that would be considered as a red flag or a problematic thing. Next, we'll look at the tax rate percentage. This should be around what other peer group companies are paying. And if there are large variations, then that would also need to be investigated. This is a tax rate percentage as a percentage of total profit before tax. So the company in the recent 12 months had paid around 38% as tax on its total revenue generated. This is quite high, so we'll need to investigate. In fact, from last 4 or 5 years, the company's tax rate has been quite stable at less than 40%. Individually, if we look at the values of tax paid, we can see that it should be stable over the years. From 15 to 19, it has been increasing. When I say stable, it means it should be gradual even if it's increasing. So we see that in 19, the tax paid was quite low at 38 because the profit before tax had also fallen to 98 crores from 217 crores in March 18. So because the profit fell, the amount of tax being paid is also low. In the recent 12 months, the total profit being declared is just 130 crores, which is even below the March 18 and March 17 values. In fact, it is even below the March 16 value of 146 crores of profit before tax. So not only should we see a rise in the profit before tax over the years, but the tax being paid should also increase as the PBT increases. Next, we'll look at the interest coverage. This is the coverage or ratio which measures the company's ability to pay the interest on its borrowings from the total revenue earned. Interest coverage should be greater than 4 times of the EBIT. So we see in most of the years, at least up till March 17, the coverage was above 4 times. Whereas in 18 and 19, because the earnings before interest and tax has dropped, that is why the company's coverage has gone below 4 times, which is the critical mark, at least for me. That's my benchmark. And in the recent 12 months, it has fallen below 2.9 times. We should make sure that the company has company is in a position to pay off its liability or pay off its interest cost with the profits it is earning. So anything below 4 times is little critical. So we should take that. We should note that if consistently the coverage is low over the years, that would be a red flag. At least for the recent 3 years, the coverage is quite low, so that would be considered as a red flag. So then from this ratio, we can try to understand why the company is not managing to generate a higher EBIT. The EBIT trend should be increasing consistently. So from 15 to at least March 18, so from 15 to March 18, the EBIT increased to 86 crores. Okay. So looking at the individual values, we can see that the EBIT increased from 118 crores to 303 crores, which fell to 138 crores in March 19 and 198 crores in the recent 12 months. So at least for the recent 12 months, it has managed to go up, but the interest cost also has gone up along with it. Interest expenses should be stable or growing gradually, which we see here in this chart that between March 17 and March 18, it had almost tripled from 32 crores to 86 CR. Interest expenses reducing is a positive, so which we did see from 18 to 19 that the interest fell from 86 to 40 CR. It is positive because it shows that the debt is also reducing, or the company has paid off its debt. It's a red flag if there is abrupt increase in the interest cost, which we saw from March 17 to March 18, and even from March 19 to the recent 12 months, the amount of interest being paid has almost doubled, less than doubled. Again, EBIT decreasing consistently over the years is also a red flag. Although for 1 year it did decrease between 18 and 19, but again it has picked up from 138 to 198 crores. So when we look at this quantitative analysis of the company's three statements, what we will understand is the overall working of the company. We cannot go to the management or ask them one to one. So we have to rely on these numbers and try to gauge from these numbers whether this company is worth our money. Can we put money? Can we buy shares of this company? And that can only happen when we do our own analysis by looking at these individual ratios, which tell us a very clear picture, or gives us a very clear picture of what's happening in the company. Next, let us look at the net profit margin. This measures the company's ability to remove profit from the business activity after accounting for all the cash as well as non-cash expenses. The net profit margin should be greater than 10%. Except for March 15, none of the years the company managed to generate about 10% of NPM. We can also look at what the other peer group companies are earning, because then that would suggest that we are in a maybe this company is in an industry where the margin is very low. It would be a red flag if the margin is consistently low over the years, which we see that from 16 till the recent 12 months also there's a lot of margin pressure on the company. It's not able to generate profits for the shareholders or from its business activity. Net profit should be increasing gradually over the years, which we see in this chart that from in March 15 it had earned 81 crores of profit, and today in the recent 12 months it's at just 79 crores, even 2 crores below the profit that was in March 15. So we see a drop or decrease in the net profit in the recent at least 2 or 3 years. Inconsistency in the net profit figure over the years would be considered a red flag. And if also we need to check this value of net profit with the cash coming in from operations, or the profit before tax with the cash coming in through operating activity. And because that would suggest that whether the company which is showing this profit of 79 crores in the recent 12 months or 60 crores in March 19, is it receiving cash against that? If there is a substantial mismatch between the net profit shown and the cash earned through operations, then that would be considered as a red flag. Next, we'll look at the average NPM. If one of the years NPM is low, then that's not a concern. But if consistently over a period of 3 years, average NPM falls below 10%, then that's a problem. So at least the 10 years average is showing around 11.9%. I generally don't look at such high averages of 10 and 7 years. I concentrate mostly on 5 and 3 years. And if these are above 10%, then it's okay with me. But here the average is way below the 10% benchmark that I set for myself. Even in the recent 12 months, the benchmark is quite low at 3.3%. The average NPM of both the 5 and the 3 years should be greater than 10%. And it's a red flag if the average NPM over the long duration of both 5 and 3 years are below 10% or below the industry standard. So we can also compare this with what other peer group companies on average are earning as their net profit margin. In this chart, we are looking at the profit growth rate or net profit growth rate, and this measures the speed or the rate at which the profits of the company is growing over the years. Any inconsistency in the net profit growth rate is a red flag. Degrowth in net profit is a red flag, and a high net profit growth rate is also a red flag. So all these three are red flags, and we need to verify this. So we see from as of today, we go back 10 years back, the company had earned more profit 10 years back than what it has earned today. From 7 years back also, the profit has fallen today. From 5 years back it has fallen. Even from 3 years back it has fallen, which we can verify from our previous chart. Here we can see individual values. At least from 5 years back the current profit is down. From 3 years back, that is from 17 or 16 rather, 16 to 19 the profit is down. From 5 years, that is from 14 to 19 the profit is down. From 7 years back it is down, as well as from 10 years back it is down. So when the profit is down from 10 years back, then that's definitely a red flag. We don't want the profit to be falling where the company had earned 10 years back, the profit which the company had earned 10 years back. The recent growth rate is of no importance as such, because we should base our investment decision based on little long-term numbers of 5 and 3 years at least. In this valuation ratio, we are looking at the market cap to sales ratio. That is, what is the company's market cap and how much sales it has done in the current year. So we don't want the market cap to sales ratio to exceed 2.5 times. That is, if the company has done a sales of 100, the market cap should not be more than 250. So when we look at this chart, we can see that the market cap to sales ratio has been consistently falling from 2.8 times to 1.43 times. This shows that the market cap is coming very near to its sales or what the company is generating as revenue, and this is how it should be. We should buy as low as possible to the market or to the sales. That is, the market cap to sales ratio should be as low as possible. So we should always buy when the market cap to sales ratio is less than 2.5 times, or if whatever the industry average standard is. So individually, if you look, the market cap in March 15 was around 2200 CR, which increased in March 18 to 3900 CR. But in March 19 the prices have fallen, the share price has fallen, and the total company's market cap has decreased to 3100 CR. which is even below March 16 figure. At the same time, the sales has been increasing till March 18, and there was a slight drop in March 19 to 2200 CR. So whenever the sales would drop, the company's market cap would also generally fall. If there are large variations in market cap over a few years, then that would be considered as a red flag, as that indicates a high fluctuation in the prices of the shares. Dividend payout. This measures what portion of the profit was distributed to the shareholders as dividend. Dividend payout should be consistent over the years, which shows that the company has a stable dividend policy. So in March 18, the company paid 40% of its profits as dividend, which it had been doing in March 15 and 16 as well, consistently at above 40%, except for March 17, where the company gave out only 30% of profits as dividend. In March, we don't have the March 19 values here, so we'll ignore this. We can see that the company had earned 81 crores in March 15. Out of that, 35 CR was paid off as dividend. And in March 18, the company had 132 CR of net profit. Out of that, 53 was paid off as dividend. Next, we'll look at the price to earnings ratio. This is also a valuation ratio. It measures how many times more we are paying for the profits earned by the company for each share. Share price is expensive when the price to earning is about 25 times, and a low price earning only means that the share price is relatively low compared to the earnings of the company. A low or a high price earning has nothing to do with the quality of the company, and we want this price to earnings to be below 25 times when we make our investment decision. So in most of the years, the company's price earning was about 25 times, which can be seen from this chart. Even in the recent 12 months, the price earning was quite high at above 38 times. So value wise, we can see that the price was 171 rupees per share in March 15, which increased to 293 rupees in March 18, and now in the recent 12 months, or the recent price was at approximately at around 228 rupees as of date of recording this video. The profit that the company earned per share was at around 5 rupee 89 paise per share. On that, we are paying 228 rupees to purchase this share. So that's a 38 times multiple that we are paying against the profit of the company. Similarly, in March 19, the company had earned 4 rupee 52 paise per share as profit, for which investors were willing to pay 239 rupees, which is a very high multiple. And I would generally not buy any company about 25 times because that's my benchmark. I would generally wait for the price earning to fall below 25 before I can make my investment decision. We can also look at the average price earning and compare that with the current price earning to understand where the company's averages were. So from last 10 years, the company has always been trading at above 31 times. So when we look at this particular chart, then we can adjust our benchmark of 25 times and increase it to at least 30, so that then we can at least buy, because we know that this company's price earning never falls on an average basis above 30. So then we can increase our price earning, and we don't need to be very rigid about where we enter based on our price to earning. So recent 3 and 5 years, we see it was above 35 times. That is, the price was 35 times more than what the company was earning as profits per share. So we compare the current price earning with its average of last 5 and 3 years and see whether currently are we getting it at a discount below its average or at premium above its averages of 5 and 3 years. So this concludes our analysis of the profit and loss account. In the next video, I'll analyze the balance sheet. Thank you for watching this video.